most producing companies now have strong balance sheets that generate very healthy free cash flows because commodity prices for precious metals are relatively high compared to the long-term historical averages.
So hello and welcome to the one-to-one global online precious metals event. Today I'm here with Angelos Damaskos, Chief Executive Officer at Sector Investment Managers Limited. So Angelos, thanks for joining me here today.
Thank you, Amy. Good to be here.
And so we're going to be talking a little bit about exploration and financing for new gold projects. So I was thinking maybe we can begin with a quick overview of global exploration financing trends. So we saw that exploration budgets were up slightly in 2022. What do you see happening as we progress through 2023?
Yes, Amy, I think it's important and interesting to look back into the longer term cycle of the industry. And I think it's important to note that the industry went through a significant bull market period between 2002 and 2012, lasted over 10 years, where exploration budgets blew way over the previous levels and there was increased activity. And that resulted in the market obviously overshooting on the upside, and then the subsequent 6-year bear market to 2018, when gold prices consolidated lower. The market was very negative towards mining companies, believing that they were overspending their budgets and they had leveraged their balance sheets. So the mining companies and the teams in general retreated into lowering operating costs, trying to pay down debt, restore the balance sheets, and survive this dramatic bear market and downturn in the industry. So as a result, I think because exploration spend obviously precedes discovery rates by several years, and it takes several years for a deposit to come through, we have seen now a dramatic drop in new initial resources recorded in recent years. For example, according to market intelligence data, initial resources announced in the last 2 years were less than a third of those announced in 2012. So it shows that this dramatic cutback on capital expenditure in exploration spending has resulted in less resource coming through the market, and obviously that impacts on the reserve replenishment ratios of most companies and the size of deposits that are being brought to market. So it's only in the last couple of years that we have seen a little bit of a recovery in exploration activity and a rise in the budgets. But again, it is by no means anything close to what we saw in 2012. So as we enter the new bull market, so to speak, in gold and precious metals of 2019 and 2020, the exploration budgets increased, but they are still way behind discovery rates and showing new deposits and new resources.
Okay. And so, for those that are financing this type of exploration, where is the money coming from?
Well, it is still a very sensitive market, I would say. We have seen gold prices consolidate or trading sideways for the last year and a half now, which was a surprise to many following the Russian invasion in Ukraine and the geopolitical tensions and risks rising globally. Most of us would have thought that gold as a safe haven would rise significantly higher. So as a result, it's also that investors have been very cautious about the mining companies. And we only see specialist investors participating in financings and willing to provide capital for development of projects. Needless to say that most investors still shy away from grassroots explorations. They mostly focus on discovered resources and drilling in the vicinity of proven areas where it is the risk of failure, so to speak, or the risk of not discovering enough new reserves or resources is much lower. So it means that we only see the participation of specialist investors at the moment, and still the generalists are staying on the sidelines and perhaps only take an interest in the integrated majors.
Is the the interest in the brownfield projects mostly due to that risk aversion by investors?
Precisely. Investors focus on existing discoveries or past producing operations that can be restructured and brought back into production if there is a clear economic viability analysis that demonstrates that the costs of bringing back to production are modest and in relation to the value of the production profile. And in addition to that, we have also had the impact of high inflation in recent months because of commodity prices across the board rising. And also the logistics breakdown in the world, which, as we know, have resulted in delays in provision of equipment. So the development of brownfield projects is even being hampered by higher costs of development, but also potential delays in implementation. Interesting.
I mean, in past years, we saw quite a bit of these kind of large-scale M&A activity from the larger gold mining groups. Is this kind of the way forward then for exploration for these smaller companies?
I think the corporate activity in the sector goes hand in hand with the sentiment of the investment community. And obviously, when we see generalist investors standing back and not willing to participate by investing in the mid-cap companies, management teams also tend to be more defensive and guarded. So far in the last couple of years, we have seen some mega mergers among the majors, which in my mind do not really result in any operational efficiencies and mergers sort of operational cost improvements. It's more a case of growing in size, having a greater diversity of operation, lowering risks, being able to return capital to investors, which is what investors have demanded. But we haven't seen participation in corporate activity by the mid-cap producers. And this has been a little bit of a puzzle to us, because most producing companies now have strong balance sheets that generate very healthy free cash flows because commodity prices for precious metals are relatively high compared to the long-term historical averages. And therefore, the many mid-cap producing companies have significant capital to deploy for corporate transactions. And in addition to that, we can see that most of these companies suffer from the so-called reserve replenishment ratio, i.e. they produce more than they find. And therefore, their life of mine, on average, as corporates, tends to be shrinking. So I believe it's a confluence of events. It's a function of the investor sentiment, and it's like a coiled spring that is being compressed all the time. And at some point, it will have to unfold. It will have to result in more activity, because we know that exploration spending takes several years to result in new reserves. And the easy way to solve this shrinking reserve replenishment ratio is to acquire assets that are ready to bring to production in a short order. So again, in my mind, the brownfield sites, the projects that have strong economic viability and near-term production profiles, will be the beneficiaries of such corporate activity.
Absolutely. Yeah, that makes sense. The topic of ESG has been coming up quite a bit around as impacting investment decision making. Do you see this kind of question about gold's use, or gold's I suppose role within the energy transition or impacting investor interest?
Yes, it definitely has a significant impact, but I believe that ESG and the very negative connotations against gold mining was a theme of 2018 and 2019, and that was the height of this ESG movement, when many large funds decided they wouldn't invest in mining projects or they wouldn't invest in oil and gas because of the negative impact to the environment, considered as heavily polluting industries. And it was particularly negative on gold mining because it is seen as gold is seen as a non-essential commodity to global economic activity. It is seen as a safe haven asset that is preferred by central banks and investors who wish to have an alternative store of value for their wealth or their reserves. And therefore, why should we encourage the mining of such a commodity, which is very polluting and highly energy intensive? So there was a fairly negative sort of backlash, but the gold mining sector listened, and most companies have taken very, very strong actions to present a better ESG profile. And that is in all the elements of ESG, environment, social, and governance. We believe now that most of the companies follow best practice. They are managing to reduce their emissions. They are managing to optimize operations. They are contributing a lot to the local stakeholders in the society by engaging in development programs in the region of their operations. And they have strengthened the governance of their operations with responsible and independent parties who are able to encourage the best adherence to ESG principles. So I think that most of the companies now have a very strong ESG focus, and investors seem to be much happier about it. So in the last couple of years, we have seen a great reduction, if you like, in the concerns of investors or questions about whether a company A or B adheres to ESG principles.
Yeah, absolutely. And so my last question is really kind of a look forward. So, for juniors looking to raise cash for exploration programs, I suppose, what are their options, and where do you see the market, I suppose, going as we progress through the year?
Yes, I think the market has improved dramatically in the last 3 to 4 months. We went through a very severe bear market in 2022 that saw a bottoming out process during the summer. And come September, October, obviously gold prices recovered, and therefore so did the outlook for the operating companies, the mining companies, including exploration or development of brownfield projects, so to speak. But still, financing is still scarce. Non-debt financing for development projects is still tough to structure. Financiers are aware of the potential delays in the supply of equipment. They tend to factor in large contingencies for cost inflation. So these aspects make financing more expensive, require more equity from the sponsoring company, and involve multiple structures of debt, mezzanine, and various tiers of collateral. So it's still not an easy market, not a lot of capital available for the mining sector. It's even less, there is even scarcer availability of capital for earlier stage exploration projects. So only the best of breed tend to be able to raise capital, and even those companies are not able to raise huge amounts of capital. But I think as the cycle develops and we see gold prices, which in my view will tend to try to go higher, given the macroeconomic outlook over the next couple of years, I think there will be a lot more capital coming back into the sector. But certainly, I don't expect anything in the region of the highs we saw in 2010 to 2012, which was the previous peak of the cycle.
Absolutely. Well, it's certainly kind of something to keep our eyes on as you know, as we move through the year. Angelos, thank you very much for joining us here today with the one-to-one Global Online Precious Metals event.
Thank you, Amy. Always pleasure to be with you.
Thank you.